Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Carl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast. Welcome to today's podcast. We have some interesting topics to discuss today. I am Nathan Merrill of Goodspeed Merrill, attorneys at law, and with me today, we're going to be relying heavily on Carl Frank for understanding some of today's topic. But Carl Frank with A&I Financial, welcome, Carl.
Hey, Nate, it's great to be here.
And we are in one of our virtual settings today, so hope that you can bear with us and that we get this mastered well for your listening enjoyment. But today, I'm going to kick off our discussion today by revealing a little bit of personal email I got. I was talking about this with Carl before the podcast, and it really frames well what we want to talk with you folks today about. And it was an email I got just moments ago from Starlink. For those of you who don't know who Starlink is, it's Elon Musk's low latency, low flying satellite internet, wireless internet that he's been shooting.
They're becoming famous in the Ukraine because they're helping the Ukrainian fighters fight against Russia.
Right. They're helping maintain connectivity in Ukraine. He's basically challenged Putin to a fight, I think.
That's right. Yeah, Elon's always got something interesting to say.
But I actually enjoy this service out at my ranch property, which is in the middle of nowhere. And so what they did was they sent us out an email. Has nothing to do with Ukraine, but they indicated that they're going to be raising their prices functionally by 10%. So the cost of the new kits is going up 10%, and the cost of monthly service is going up 10%. So what we thought we would talk about today, and that is a lead-in, is I think there is a lot of discussion about this, is the inflationary pressures we're seeing. Inflation being effectively, or maybe Carl, do you want to define the true definition of inflation? Because it's not just rising prices, is it? It has more, that there's more to it than just seeing prices go up.
Yeah, that's exactly right. I mean, I think about it, really, you boil it down, and inflation is the loss of purchasing power. That the real deal is that your costs are going up higher than your income, and it's destructive. It's, there are big downsides to inflation, and even the wealthy feel it, right? Anybody of any income source feels the psychological effects of prices going up. When you could buy something yesterday for less than you can buy it for today, it's hard. It's hard on you emotionally, and it's obviously hard on you financially. So I don't know if that's the official legal term, Nate. That's the way we think about it, purchasing power.
Sure. No, that's effective for purposes of our conversation. And I think it's also important to recognize that at least the way our monetary system works, there's an implied understanding, or if not tacit understanding, that inflation is an expected event, that the Federal Reserve, as it were, anticipates or is designed to create or enable a certain amount of inflation.
Yeah, that's a really good point. I think a lot of economic theory is based on the fact that we'll have modest inflation, and that modest inflation is actually a good thing. I remember in undergraduate school, starting out as an econ major, and I thought, this is really bizarre. Why would I ever want prices to go up? And my professor just weaned it into us, in our freshman economics class, that modest inflation is healthy, that you want to see prices increasing at a rate that's sustainable, and not the opposite, deflation, which at that point had just begun, if it had, in Japan. And Japan is a famous case of what can be bad about prices declining. So I think we've got a really interesting situation here, because for most of our business career, Nate, we've been in a very modest inflationary environment. We've been in the lowest inflationary environment for the past 40 years in the history of our country. So to all of a sudden have inflation over the past 12 months spike up to the numbers that it's reaching now, which I think are in the 8% range or higher, depending on what you look at, it's pretty dramatic, and I think people are really feeling it.
So absolutely. And as a point of reference, I think would be helpful for our listeners to understand how this compares to other inflationary periods. Do you have any, I know you've been pulling together a lot of data for today, and I don't know if I'm reaching into data sets that you don't have, but I think we're all aware of kind of the most recent super inflationary period was the 70s. Some of us may have actually had to live through that.
Yeah, I think, I hope, I know a lot of our listeners were alive during the 70s. You and I were, and coincidentally, we're the same age. But yes, absolutely, this is a lot like that, and people really feel it, because a lot of the people who are in charge now, whether they're in charge of investment banks or corporations or politically in charge, were young in their careers in the 70s and the early 80s, when inflation was out of the world. And we are now reaching rates that are approaching the same rates of inflation that we had in the late 70s and 80s. And on my screen, Nate, you and I are looking at it right now. It is a big change in a lot of different categories. So it's hard to paint the picture for our listeners, but imagine bar charts, and there's two color bars. There's a red bar, which is the nominal sales, and then there's a blue bar, which is a smaller, which are real sales. And so when we look at the sales numbers that are going on around the country, they are good because prices are up, but the actual amount of stuff being sold is not up. In fact, in some cases it's down, even though the prices are up. And so it looks better than it really is.
So revenue is flowing, but product is not, is basically what you're saying.
Yeah. Product is not flowing as much as the revenue, because the inflation is inflating the numbers. It's making things look better than they really are. Saudi Aramco just doubled their profits quarter over quarter. And, it's the world's largest oil manufacturer. It used to be the world's largest company. And
but in real terms, gas sales, is that what you're getting at? I mean,
yeah, isn't that fascinating? Right. Yeah. Look at this bar. And so imagine this, listeners, you got a big bar, a red bar that shows gasoline sales up 38% year over year. And that's what powered, that oil company's profits. But then a negative blue bar down 1%, because the actual amount of gasoline that was sold was less quarter over quarter than it was. It's really, really interesting to see that happening in our world today. And that's this is a 2-year comparison. So this is 2 years ago, before the pandemic.
Is that all a product of monetary policy? Is that a product of, because has supply really cut back so much that price would increase that much? Or is this on the other side of that coin, we just have more dollars out there and therefore our purchasing power is decreasing? Or is it a combination of both?
Yeah, it's a combination of both and even more. So absolutely, policy has a huge effect on it. I mean, when we say we're not going to produce domestic oil, that reduces supply. And then obviously world events are causing an increased demand, based on what's going on in the Soviet Union. We've got it in Russia. I still want to call it Soviet Union because the guy in charge is KGB thug from the Soviet days. But I digress, right? That he's screwing up. The horrible situation in Ukraine is screwing up supply. Monetary policy is a huge part of it. But to counter the monetary policy, I mean, we've got a lot of money, all the money that in our country and other countries around the world also released a lot of dollars to help us fight the pandemic. So America's not alone. I mean, inflation is a worldwide problem. Monetary policy released a whole lot of dollars, but to counter that, you would think that, well, then sales would go up, and the opposite is the truth. At least is the truth. The opposite is the truth. That in America, people are consuming less gasoline. We're changing our behaviors. We're declining in the amount of goods and services that we're purchasing. I've got another bar graph here, and this is a really interesting one to me because this rings true to me. This is like, oh, okay, here's some statistics. I'm not alone. There's a whole lot of Americans who are just like me. And it says that inflation is already altering consumer behaviors, that we are planning on spending more money on the essentials. And maybe we're planning on it because it's just a lot more expensive. On this chart, the bars go from left to right. We're planning on spending 23% more on groceries, 18% on utilities. Education is up 14%. Childcare is up. In-home entertainment is up. Rent and mortgages are up. Financial services are up. Paying off debt is up. But almost everything else is down. Meaning like clothing, we'll spend less on clothing. We're not expecting to spend a whole lot more on travel, which is really disappointing to me. Out-of-home dining, we're planning on spending less because of inflation. Gym and sports memberships, and buying stuff, buying the goods and services. We're planning on buying less durable goods and other things like that. And that rings true. When the prices are up, if you don't need to, maybe you can just make do.
It's interesting. One of the things I'm seeing here is home improvement. The expected, this is in the coming 12 months, this chart, home improvement is anticipated to be down, 11%? And I'm just thinking that's also possibly in part because so many people did home improvement during the pandemic, because the home improvement stores were going gangbusters for a good 2 years. But some of this stuff looks like it's offsetting. Like when people realize they have to pay more for groceries and utilities, the things they cut out are entertainment and dining and travel and some of that stuff. So they somewhat offset. Perhaps you can speak a little bit to how does this chart at all inform you when you anticipate whether we're seeing recessionary indications, or is this just a true offset in terms of things we're buying?
Funny you should ask that. That's a great question. And I think Jerome Powell actually said today or yesterday, anyway, very recently, that if you're worried about recession, pay attention to the really short duration treasury curve. Oh my gosh, I just threw out a whole crazy phrase. But Jerome Powell's in charge of the Federal Reserve, and he says that he's not worried about a recession, that they are going to raise rates at a pretty fast pace to fight inflation, that they're now all guns a-blazing to fight down inflation. And they've only got two tools in their tool belt, and one of them is raising rates. And so, they got a lot of other creative ideas they've used lately, but they're two big ones. And so the inflation fighting prowess champion, the champion of the Federal Reserve, says if you're really worried about a recession, look at whether the shortest term government bond that you can buy actually pays you a higher rate of return than a longer one. So in other words, if I can get my money back in 3 months from the Federal Reserve, if I loan them $1,000 and they pay it back to me 3 months later, and over that period of time they pay me a modest interest rate, if that's a higher percentage rate than if I had to wait 2 years or 10 years or 30 years to get my money back from the government, that's called an inverted yield curve. It means that a recession may be coming. And so, that may be true. I don't know that Jerome Powell has any more insight than the rest of us, to be honest with you. He's just another guy. We're all making investment decisions. But the truth of the matter is that when you're facing an inflationary environment, you have to change your thinking a little bit. You have to be a little bit more comfortable with short-term craziness, because there's not going to be a short-term fixed rate investment that's going to be higher than the rates of inflation we're looking at today. We're going to have to put our money either into an investments that are short-term volatile with higher potential long-term rates of return, or we're just going to have to be comfortable with the assumption that a lot of the stock market has, which is that inflation might be high for a little while, but it's not going to be high for a very long period of time. It's okay if you have your money in a fixed rate investment that pays you less than inflation for a short period of time, because inflation isn't going to last. So you're making one of two choices, and neither one of them are very comfortable. We tend to lean on the side of investing for the long haul and not trying to bet inflation on the short term. Over the long haul, you'll win, but over the short term, it can be really hard to ride through a volatile stock market like we're experiencing and be looking at, grocery store prices, which it feels like almost every time we go back, we're spending a little bit more on groceries than we did the week before.
Absolutely. And then things like the Starlink, I think salaries have started to climb along with inflation. That has somewhat to do with both the cost of living as well as supply and demand. It appears that the Great Resignation has resulted in some upward pressure on salaries in almost every industry, every area. Which certainly has
it's hard to hire.
It's almost a vicious cycle at some level, and I guess what I'm hearing from you, it will take a little bit of time for that to normalize, for the supply issues, the demand, the overheated demand. I mean, as I understand it, you have overheated demand from excess capital in the markets. People have done well in the stock market because a lot of what's gone in has kind of inflated up their portfolio values. They're doing some profit taking. They're feeling rich, and so they're going out shopping, at least have been. And then on the supply side, we've had all these supply chain interruptions that have prevented goods from getting to market. We have now people leaving the workforce that's just going to make things more expensive to produce. So you have two different types of pressures that are pushing. Is that one of the reasons why what we're seeing is beyond the typical inflationary cycle? Because I think what I heard from Powell last year was that, everybody was saying, and whether you're a cynic or not, I'll leave that to you to decide, but everybody was saying, oh, this is just transitory. It's transitory. It's transitory. And the way I understood that was they thought that this would subside by the end of 2021. And here we're still seeing inflationary pressures and so now the Fed's kicking in, maybe just in time, maybe too little too late. I'd be curious your thoughts on that. I know that we read some comments that maybe the central banks got caught off guard here and now they're playing a little catch up. What are your thoughts?
Yeah, that's exactly right. I think I agree with that. There's a recent poll by Bloomberg Company, not the man who ran for president, but the company that has his name. And it looks like 2/3 of Wall Street believes that we're late, right? And that Federal Reserve is late, and that central banks all around the world are late to the game, that they've got to do more to fight inflation. And that just rings true. That seems to make a lot of sense to me. I know that at our firm, when we manage money, we make investment decisions, we talk to a diverse array of really smart men and women who help us make these decisions. And the vast consensus among them is in fact, one of them very astutely pointed out to me the other day when I asked him this very question. He said, the Fed should have started raising rates in 2012. Yeah, it's not
sure.
Late. It's really late.
It's extraordinarily late to the game.
Nate, this was a lot of fun. Thank you for inviting me to be here, and I look forward to seeing you again soon.
Have a blessed day.
Great, beautiful day.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.